Australian consumers are facing into a very challenging environment the next couple of years. Essentially, we're in the midst of an inflation lockdown in Australia. Inflation's far too high. The RBA is signalling it's clearly intent on bringing inflation back to the 2 to 3% target range. The hit to disposable incomes and the hit in terms of higher interest rates is putting a very significant pressure on Australian households, and they're facing into 2 years of very weak activity. The most recent round of changes have been in response to concerns that inflation expectations are starting to shift. We now see the RBA delivering another 2 rate hikes in the next couple of months. That takes the tightening since last year from 4 percentage points to 4.5 percentage points. That's a very steep rise to absorb for Australian households. At the same time, the surge in prices, we've seen the CPI rise over 10% since the Delta lockdowns. That's eating into disposable incomes in a dramatic way. All up, we're absorbing a very large hit to disposable incomes in Australia, and we're facing into 2 very difficult years for consumer spending and for growth more generally. We think it's a consumer stagnation this year and next. It'll be the weakest 2-year period we've seen historically. And for households, it's still a way to go. So for consumers, it means they're really bearing the brunt of these policy measures and the inflation impact itself. If we look at household disposable incomes, for example, over the year to March, these contracted 4% through the year. So that's disposable income after interest and tax payments and after inflation contracted by a full 4%. That's much bigger than any contraction we've seen historically. It's bigger than the contraction we saw in the early 90s recession. Fortunately, we've had these pandemic savings accumulated through the pandemic that have helped support spending through that period and buffer the shock. We've also had these fixed rate loans which have dampened some of the interest rate impacts, and the labour market's been in relatively good condition. If those 3 supports hadn't been in place, spending would be wheeling backwards at quite a rate at the moment. Instead, it's stalling. What we're seeing in the last couple of quarters, in the March quarter we had a 0.2% gain in consumer spending. It's very insipid. When we're allowing for 2% population growth, it's telling us that per capita spending is already being wound back. We can see it in other aspects as well. Our consumer sentiment survey, our readings on consumer sentiment, the average read over the last 12 months has been just over 80. That's 20 percentage points below 100. That's deeply negative. For a 12-month period, that's the second weakest 12-month run we've seen in 50 years, the weakest being in the darkest days of the early 90s recession. So for Australian households, this lockdown is a very serious event. The inflation and interest rate pressures are intense, and we think it'll slow the economy, slow the spending significantly, and slow the wider economy over the course of this year. It's only just starting to show through. There'll be some more pressures in coming quarters as the latest round of interest rate rises flow through. So we get a quite good visibility around the most recent trends in spending from our card activity data. The Westpac Card Tracker tracks credit and debit card transactions across the bank's system. And it's warning for the second quarter there's a significant downside risk. What we saw in the March quarter earlier in the year was card activity stalled about flat for the quarter, and as we saw with consumer spending, it only just rose 0.2% overall. For the June quarter, it looks like we may be seeing an outright contraction. The data we have to date, which is up to mid-June, suggests that maybe activity contracted around 1% in the quarter. That's in nominal terms, so that's including any inflation. So it's definitely flagging a risk that the second quarter has been very weak for consumer spending, reflecting the accumulated pressure from higher cost of living and higher interest rates over the last 12 months. We'll see in the next few weeks how that plays out for the remainder of the second quarter in card activity, and then we'll start to get the official figures. Next week we'll get May retail sales numbers from the ABS, which will give us a portion of that consumer spending picture on an official basis and may confirm that soft picture more generally. Certainly, as we move forward, the next few months it's going to be much clearer that the consumer spending picture has weakened, and that alongside an easing in inflation and some softening in the labour market will be the cue for the RBA to go on hold to put its gun back in the rack and allow consumers to absorb and cope with what we're seeing at the moment, and inflation to come back under control as we go through this slower period. But the next few months will be pretty vital in terms of that situation. As I said, the RBA at the moment is more concerned that inflation is becoming entrenched, and a bit like the pandemic, inflation's a bit of an invisible threat, but it's a very serious one. And if we don't deal with it immediately, we face the prospect of a multi-year fight and a much weaker economy off the back of that. So the inflation side of the story is obviously still very important, but we think once the weak consumer picture becomes much clearer, the RBA will be more comfortable that inflation will track back to its target. There are positives in the mix. Don't get me wrong, we've got strong population growth, which is helping in terms of sales more generally. We're having some lift in wages growth and some fiscal supports. We have stage 3 tax cuts penciled in for the third quarter next year. That delivers about $20 billion a quarter as they start to roll through. So it's not all this negative interest rate inflation story, but it's certainly the dominant issue for households, and it's going to remain that way until this inflation threat really comes back to stability. Without a doubt, it's a challenging outlook for Australian households. But I think we need to keep some perspective here. The alternative outcomes in which high inflation becomes a permanent feature of our economy are a lot worse than what we're facing into over the next couple of years. And we have a pretty good shot at bringing inflation under control. Back in the 70s, we messed this up badly, and we had 2 decades of high inflation and a very costly effort in bringing it eventually back under control. This time around, the response from policymakers, central banks in particular, has been immediate and forthright, and so far it's been quite successful in preventing that really big breakout to double-digit inflation that we saw in the 70s, and it stands a pretty good prospect of bringing inflation back under control. So in terms of perspective, yes, it's a very difficult couple of years, but a difficult couple of years is better than a difficult couple of decades.